Hi Shatya.
Hi, Samir. Yeah, so couple of my friends will also be joining, so we'll just wait for them for three
Okay,
minutes,
okay,
then
sure.
we'll start.
Okay.
Okay, so yeah, Yashwant, I mean, the person who's supposed to be attend this session, yeah, he is here, and one of my friend is also here. So we can just start the meeting. So I have started the recording. So yeah, we only have half an hour time. So let the others join. If they join, like they can continue in the middle. Anyway, I am recording the session. So actually, the main motto of this session is like, I mean, from the last 6 to 8 months. So I hope you are able to view my screen, right? Samir, you are
Yes.
able to, yeah.
Yes.
So actually, like from the last 6 to 8 months, like after the COVID and the market crash happened, so I started reading about the things like, I mean, how to gain knowledge on the stock market and how to earn money and how not earn money, like how to invest in the stock market without losing the capital, actually, the main initial capital. So like, I mean, I just wanted to share all the information that I have gained in the last few months with you guys so that it can be helpful for you. And also like it is kind of a refresh for me. Okay. So actually, like, I mean, the main question here is like, I mean, so I have created a small PPT, but I mean, you can find like all these are kind of meaningless, but these are just for my reference. Okay. So I will start the discussion. Then in the last 10 minutes, you can ask the questions. It is a simple one. Okay. If you know the basics, then it is kind of like deja vu to you, but it is, I'm trying to cover all the basics. Okay. So right now, okay. mm, how to do the slideshow? Yeah. So the first question is like, I mean, why do we need to invest? Okay. So obviously, like, I mean, take an example, like, Samir, like your age is around like 27, 28, right? So
Yes.
27.
Yes.
So you want to retire after 50 years when you reach 50. Okay. And after retiring, you don't want to work, you don't want to do another job, like as you are doing like much work in software. So you just want to retire after 40, 50. And after you retire, you need something like where you get the monthly income, some investment. You need to see some money, like where you can just enjoy your life without working. So that is the main purpose, that we need to invest. And other things, like once you get married and you, I mean, like to take care of your child education or child marriage, you need some money, right, when the time comes. So for that thing, you need to invest some money. So actually, like, I mean, all of us, like all the software employees and all the other, like who are the private employees, we normally do not invest actually. So if we get 30,000, we kind of spend all the money, like 30,000 normally. It's like we cannot complain, but it is how we live actually. So like, I mean, if you read all the books, like all the money management books, all the good authors, they suggest you to, like, I mean, suppose if you're getting X amount as your income per month, so you should at least invest 10%. At least 10% should be invested. And based on your goals, like, I mean, based on your short term goals and long term goals, it can be extended like to 20, 30%, but the basic should be 10%. So if you're getting a 1 lakh, you should invest at least 10,000 per month. Okay. So I'm actually, like, I mean, there are many investment options. So which are fixed deposits and national pension scheme and provident fund. And you can buy a home and give it rent, and you can sell it like after, but real estate and lands. And you can also buy gold. And besides all things, there is one another thing where we Indians, like we, our generation, has not accustomed to it yet actually. So there are many people like from the Maharashtra, they're earning so much. So you do hear in the news that regularly, like, I mean, these people are earning so much in the stock markets. So many people are doing intraday and earning so much in the stock market, but we are not stepping into that area because we don't know about that field. So that's why we are kind of have a fear, like where have fear of losing the money. So that's why we don't step into that field. So that is why, so I just want to give a basic idea of like how we can earn something from the stock market without monitoring the market daily. Okay, so the basic thing is like you should invest at least 10% of your income. And the next thing, so why do people want to invest in stock market? So basically, as you already see in news daily, so they will give very high returns. And also, like if you want to get high returns, you should be able to monitor the market regularly, not like on the daily basis actually. So but for us, like for software employees and for other employees, private employees, we don't have the time to monitor on the daily basis, right? So we don't have the time to sit at 9:15 and monitor, sell the things at 3:30. So for people like us, we have an option called mutual funds. So what exactly is a mutual fund? So if you want the definition, just Google it. But I will just give a simple example. Okay. Suppose, so I want to eat corn. I mean, you have the corn, right? Where masala corn you want to eat outside. and I want to eat bel puri and I want to eat mirchi bhaji also. Mirchi bhaji is kind of South Indian food for your North Indians. So it is kind of a, what do you say? I don't know like how to tell those terms in the English, but it is kind of evening snack. Okay. Suppose you want to eat all these three, but they are like outside my limit. Suppose I have 100 rupees, but corn costs 200, bel costs 200, and mirchi bhaji also costs 200. So I don't have the money to buy that corn, bel, and mirchi. So what I do is like I go to a chart shop. So consider a chart shop is kind of a mutual fund house. So I go to chart shop and ask. So what they do is like the chart shop. So they do mixture all these things, right? They do take some part of corn and they do take some part of bale and they do take some part of mirchi bhaji. They mix it and give it to us, give it to the normal people. So as I don't have 600 rupees to buy each one of that, I will buy the mixture for 100 rupees and I enjoy the taste. So that is exactly what mutual fund is. So as I don't have the money to buy these things individually, what I do is like I choose a mutual fund house and I ask them to give some part of the mixture, like some part of corn, some part of bell, and some part of mirchi bhaji. So I can just enjoy the benefits of the stock market because I don't have that much money to invest in the stock market. So that is the basic definition of mutual fund. And besides it, there is also a like informal definition. That means suppose in like one fine evening you wanted to eat something tasty. That means in the if you take the analogy, you want to earn something from the markets, but you don't know what to hit. That means you don't know how to invest and where to invest. So what you do is like you go to the restaurant, you go to a mutual fund house, and then select the best dish. So you go to the mutual fund house and select the best fund, and you just enjoy the food. That means enjoy the profits. So just take the restaurant as a mutual fund house and the dish as the mutual fund. So so how to select the dish? You just see their menu and see the last previous, like which is the best selling dish from the restaurant, and just select the dish and enjoy the benefits. Here you are not doing anything, so you are not checking the ingredients and everything. You are just going by the restaurant name as well as the reviews of the dish. So that is how you are enjoying the market. So these two are the kind of simple analogies how we can relate our everything everyday life to the stock market. So this is what mutual fund is actually. So before knowing like where to invest and how to invest in mutual funds, let's let's talk about different types of mutual funds first. Okay. Yeah, and how to exit this PowerPoint. And sure, yeah. So instead of going all these, right, so let us open an app like where people use like normally. Yeah. So Grow app, right? I mean, I know the some of the people here know about Grow app, where like it is best for to invest mutual fund, best application or web application to invest in mutual funds. I hope you got what is mutual fund. Let's see all the mutual funds. Now you wanted to invest in the mutual funds, but you don't like there are so many categories here. So you don't know like I mean where to invest and based on your goals, like suppose your goals are short term, you should be knowing like where you should invest in the mutual fund. So whether you should choose equity mutual fund or whether you choose debt mutual fund or whether you choose some other things. Let's go by category. Okay, let's discuss about equity. So I've selected equity. So there are so many things here in the equity mutual fund. Okay, we'll go by step. So first, large cap mutual fund. So large cap mutual fund is the fund where the fund house invest majorly into the top 100 companies, like market capitalization, right? The market value of a particular company. Suppose if you see all the companies in India, so large cap mutual fund, they choose top 100 companies by market capitalization in India, and they like suppose they are investing 100 rupees, they make sure that at least 80% of that money will be invested to the top 100 companies. So that is large cap fund. Okay, at least 80%. And also we have a mid cap fund also. So mid cap fund, if you see here, mid cap fund in the sense. So actually, like I mean, normally like we do have three caps in our Indian market. So one is large cap, that means 1 to 100 companies. Mid cap companies are 100 to 250 companies, and small cap companies are 251 to so on. So these are based. I mean, these are kind of divided based on the market capitalization. So mid cap mutual fund is a mutual fund which invests at least 65% of the amount in 100 to 250 ranking of the market cap. I mean, 100 to 250 ranking companies. Okay. And also the small cap is also at least 65% of the money will be invested to this small cap mutual fund. I mean, will be invested as part of the small cap. And also we have large and mid cap funds. So large and mid cap funds, it is a combination of both large cap and mid cap. That means minimum 35% each should be invested in large cap and minimum 35% should be invested in mid cap. And also multi-cap. Multi-cap in the sense there is no restriction for the fund house. So they can take your money and they can invest wherever they want. So based on their analysis, they do invest wherever they want. And also we have focused funds. Focused fund in the sense they only select 30 stocks. That's it. So they select 30 stocks of 30 different companies. It can be multi-cap. I mean, so the companies can be what is expanded to like all the caps. Like it can be a large cap, mid cap, and small cap. But the focus fund will not have more than 30 stocks in each. And also like we do have ELSS, equity linked savings scheme. This I will explain later, but it is like, I mean, we do have ATC, right? We just want to save some tax, right, while submitting for our company. So ELSS is equity linked scheme actually. So it is, if you invest in ELSS, you can show it is as part of ATC, like, so you can get the, what do you say, like, get the tax exemptions if you invest in ELSs, but there is a lock-in period which we will discuss. And also we also have that value and contra fund. Now let's go back to the grow up. Let's discuss. So now the large cap funds are the funds where 80% of the money will go to the large cap. I mean, that means top 100 companies. Mid cap is 100 to 250. Multi cap is like no restrictions on the capping. Small cap is 250 to then, I mean, whatever, to till the last. And focused funds are the funds which only have 30 stocks. ELSs are equity linked, and contra and value. So value in the sense, so actually, like, I mean, so every fund house will have a fund manager who will take the decisions. It can be a manager, it can be a team. So they will take the decisions and they will invest our money based on their analysis. So value fund are those type of funds. So in these funds, the fund managers, they try to find out the stocks which are kind of undervalued in the stock market. So it means a particular company has good growth and good profits, but the share price is kind of less when compared to its original ability. The share price is kind of less. So they will pick those kind of stocks and they will invest as part of this value fund. They will invest the money in those type of stocks. That is value fund. And contra fund is they will go against the market trends. So right now, suppose like after the corona, from the September, the market is kind of bullish, right? I mean that every stock is gaining the price. So contra funds are those type of funds in which the fund manager kind of like short, I mean, do exactly against the market. So if the market is going up, they invest saying that they kind of short the market in contra fund. If the market is going down, they bet against the stocks which they think they go up. I mean, they which they think will go up, but in the real time they are going down. Suppose if a stock, Reliance stock, is going down in the Sensex, so the fund managers do some analysis, and if they think that we can bet against it, that means like if it can go up in the future, they will just invest it in it as part of contra fund. So it's too simple. Contra fund is those type of funds where the fund managers bet against the market. So these are the contra fund. So these are all the equity funds. So if I don't cover anything, just just ignore them. We'll just discuss in the last, as we only have 15 more minutes left. And then, so those are the equity funds. Then the other section is debt funds. Debt funds. So there are so many debt funds, but we will only discuss a few of them. So what is a debt fund? So debt fund in the sense, so in the equity fund, so the fund managers are taking the money and they're buying the stocks from the stock market, right? So as part of the debt fund, they take your money and they will lend your money to the companies or the governments. So it is kind of lending the money for to the other people for gaining the interest. So this is called debt fund. So there are so many debt funds, okay? And there are liquid debt funds. I mean, liquid debt funds like are highly like, which will be useful if you want to invest the money for less than 90 days or less than like 1 month. So liquid, as part of liquid funds, the fund managers invest the money in money market and they do invest in the treasury bills. So these definitions I will give you the links, you can google them out. And also ultra short fund. So as part of ultra short fund, actually these funds are useful if you want to invest the money for 365 days. And there are like, I mean, if you want to invest the money in 3 to 6 months, there are ultra short bonds which they will invest in T-bills and commercial papers. I will tell you the definitions later. I will just provide the links. And then and money markets, so they do invest in. So basically all the debt funds, they take your money and lend it to someone else. So if they get interest, they will pay you as dividend. Otherwise, they will take the interest and just invest again in the debt fund. So actually, like when compared to the equity fund, debt funds are kind of more secure actually. So equity funds market can be volatile because the stock market can go bullish and can go bearish sometimes. But debt funds, you are just lending the money, right? And you are also lending the money to the, what do you say, the very known companies. Like, I mean, they do lend money to the government. Government will obviously pay back, and they will lend money to the corporate companies, very big corporate companies. So obviously, the money, your money will be safe in debt funds. So there are like so many debt funds, short term and like these are debt funds. And then coming to the third section, we have hybrid funds. So hybrid fund is kind of a mix of both debt fund and equity fund. So why do people have to choose hybrid fund? In the sense, suppose like I want my money to be secure, but I want to enjoy the gains of the share market also. So for these kind of people, they can choose hybrid fund. So based on these hybrid fund, so suppose if I choose a conservative hybrid fund, so as part of conservative hybrid fund, if I give 100 rupees to the fund, I mean to the mutual fund company, they will invest 90 rupees in a debt fund and 10 rupees in the equity. So for the 90 rupees, my money is secure because they are investing in the debt fund. The other 10 rupees, it is kind of gambling because they are investing in the equity fund. So they do invest, like, I mean, in a good manner, but it is kind of risky. So hybrid fund is kind of a mixture of both debt fund and equity fund. So there are all these things. So conservative is kind of 90% equity and 90% debt and 10% equity. Aggressive is like 60% equity and 40% debt. Arbitrage, we can discuss about it. This is, I mean, kind of good. Balanced advantages is like 40-60, 40% equity and 60% debt. And equity savings, like do not like just ignore these two. Let's discuss about arbitrage because this is the kind of the important thing in hybrid fund. So arbitrage fund are those funds. In this fund, suppose like let's take an example of a Reliance. Okay, Reliance is kind of registered in both NSE and BSE. Okay, so whenever you check the price, latest price of Reliance in NSE and BSE, there will be a minute difference, right? Maybe like 30 paisa difference and 40 paisa difference. So what they do is like they will just do these transactions like cross fund, like cross, what do you say, stock market. So they buy in NSE, they sell in NSE. If they feel that the Reliance is getting for a low price in the BSE, then they invest there. So they just move around. So they just like buy in one market and sell in another market. So or in the arbitrage fund, your money is completely safe. It is as good as debt fund, and also you will get more profits when compared to all the other hybrid funds and when compared to debt funds also. But we will just discuss about like arbitrage funds like a bit in detail after that. And there are also like others like we have index fund and FOF. Just ignore this. Now we all know like the basics of mutual funds. I assume like all of you already know the definitions. Okay, now what we have, what I want to share you guys as part of this session is like, I mean, you know the definitions, but you know which fund you should select as part of your year goals. Okay, that is what I want to tell you guys as part of this session. Okay, just give me a minute, let me open my notebook also. Yeah, okay. Yeah, so normally, like as I told you, like, I mean, you should be investing at least 10% of your monthly income for your future or something else, right? Normally, suppose if I am a person who does not want to take more risk, so for that type of persons, so I did check like so many books. So they everyone suggests that the same thing, like you should invest like at least 10% of your monthly income. And even in that 10%, only the 20% should be invested in stocks, direct stocks, I mean equity or cryptocurrency, Bitcoin, if you are taking more risks. So the 20% of your investment money is kind of gambling, for gambling. And 80%, or it can be more, so the base minimum will be 80%. They should be divided like based on your short term goal, long term goals. So this is the main first thing that I want you to remember. Okay, if you don't want to take more risk and if you want your future to be secured, it is better to not to spend more than 20% for buying stocks in a month or buying cryptocurrency. The remaining 80% should be go to the mutual funds, or if you want to take less risk, go for a fixed deposit or other schemes. But a mutual fund, like we can like remove the 99%. It kind of risk free actually, if you choose correct mutual fund and if you choose correct type of fund. So let's take an example. Okay, now, so I will take like 1 2 3 5 scenarios right now. Okay, so I got my salary today. Now, so assume like I am married, I have a kid. Okay, so I want to pay my kid school fees on 7th of every month. So for the first 7 days, my money will be we will sit in the bank account as an ideal, right? So normally savings account will give like 3 to 4% of interest, and for 7 days it is kind of negligible. So I'm just taking a silly example, assuming that I have to pay my child fees on 7th of every month. So for the first 7 days, the money is kind of ideal in my bank account, right? So what I can do is like, so for the 1 week or for around 90 days, I can go for a overnight fund. So if I want to invest in a mutual fund for a week, I can choose overnight funds. So you can find all the overnight funds here. Overnight fund, you can choose overnight fund. So this is the type of fund you should go if you want to invest the money for 1 week actually. So overnight fund will be matured on every day. So if you're going to invest it today, you can take it on next day. Suppose I want to buy a house on Monday, like I have 40 lakhs in my account. So on Friday I got the money for the next 2 days, so they will be in my account, I don't get any interest on it. So what I can do is like, I can select a overnight fund and I can invest there for 2 days. As the maturity period is only 1 day, I can withdraw the amount on Monday. So I will get the amount, I can pay the 40 lakhs to the house, and I will, even it is a minute percent, I will get the interest. So the percentage that we normally get is like 5 to 8% for very short term of mutual funds. So if I have to invest the money for a 1 week duration, I have to go with overnight fund. If I have to invest the money for a liquid fund, I have to go for 90 days. Suppose if you want to buy a car but you are waiting for a sale, or you want to buy a phone but you are waiting for a sale, you are waiting for a Diwali sale, so you can just go for liquid fund and keep the money there. So at least you will get 5 to 8% interest, right? So if it is a minute, even if it is a minute thing, but you will get something, right? And for ultra short term fund, it is ideal for 3 months to 6 months investment. Low duration and money market, these are like which are ideal for till, if you want to keep the money ideal in your 1 year, like for 1 year, then money market is kind of like money market fund or kind of funds which are usable for you. Suppose let me take my example. So I'm paying a premium of 37,000 per month per year for insurance actually. So I could have chosen the EMI, but instead of choosing the EMI, I'm investing the amount in the money market. I'm taking it back at the end of 1 year and paying my insurance premium in the December month. But for the 12 months, I do get some interest, right? Even if it's like 500,000, it is a money. So that is how you should invest in these very short term funds. And also there are like short term funds. Suppose, let me take an example of car here. Okay, suppose I want to buy a car in maybe in 3 years. Okay, so normally, like, I mean, all so before investing these, so you have to make sure that you should not be using the credit cards. So if you are still using it, just pay the bill and like just close it them. Okay, and also do not take loans. So before, like, if you want to buy a car, you can just take the loan, pay the EMI. But instead of that, do like this. So suppose if you want to buy a car, suppose the car price is kind of 5 lakhs now. Okay, when you want to buy a car, you want to buy a car in like in next 2 years. Suppose the inflation percent is 5%. Okay, so the percent of the car, like the rate of the car after next 2 years will be like around 6 lakhs 10,000. Okay, the car is now 5 lakhs, after 2 years it will cost 6 lakh 10,000. So you can just do the calculator and make an investment such a way that you have to receive 6 lakhs 10,000 after 2 years. And uh, so it is a 2 year, right? So you can either go with uh, this short term like banking and PSU fund, or short duration fund, or you can go with other funds which I will tell you later. But you can just do an SIP and you will get the 6 lakh 10,000, and then you can buy a car. So because, like, I mean, you're kind of saving. So normally what our parents used to do is like, I mean, when they want to save, they were just like doing the saving in the post office or some fixed deposit. But these debt funds, like, I will tell you, like, this is how you can do the you can achieve your short term goals and long term goals actually. So short term goals are these, like, if you want to buy a car, buy a home, and go for a holiday plan and maybe for a sibling marriage. So these are all short term goals. And long term goals, like if you have kids, like it can be used for kids education and for marriage and for retirement also. But the basic thing you have to learn is like you have to choose a correct fund. Okay, so I'm giving the information, like I mean all this information. So for a short term, for 1 to 3 years, we can go for these type of funds. So they will give like 9 to 12% of returns. For 2 to 5 years, you can go for like arbitrage or conservative fund. So it will give like 6% is kind of minimum actually. You just have to choose the right mutual fund. And if you want to invest, if your goals are long term, or if your goals are you want to buy something after 5 years, without second thought, go for equity fund. And in the equity fund, you should, like, as you don't want to take much risk, you can go for large cap fund, or you can go for large cap and mid cap funds. And also, even like you are investing in mutual fund, as I told earlier, it is kind of a passive investment. But even though it is a passive investment, you should be monitoring it regularly. Maybe like your fund is kind of completely underperforming an year, so then you have to like take it out actually. So I will just explain you about those also. But if you don't want to look into the fund that regularly, you can go with index funds. Index funds are those funds, they will directly what do you say, uh, grow as per the index. Like I mean, the Nifty and Sensex, right? So these are kind of correlated to this one. So if the Nifty is increasing, the Nifty index fund will increase. So you just have to check the Nifty performance and Sensex performance on the whole. So if you don't have much time, you can just go for the index fund. The basic thing here to remember is you have to go with the fund based on your duration. Okay. So let's take an example of, suppose like we did discuss about the car, right? So let's take an example. Let's take another example. Okay. So I have to go for a holiday. Okay. And I want to go for a Euro trip maybe after 4 years from now. So my goal is 4 years. So for the 4 year, which one should I choose? I should not choose the short term, because even though I've written it as 2 years, it should 3 years. It should be only for 2 years. And very short term, it is just for 365 days. Then I can choose this arbitrage and conservative. So as I told you, arbitrage are the funds where the fund managers will kind of sell in one market and buy in another market and do the vice versa. And conservative funds are the funds where 90% of your investment will go to the debt market and 10% to the equity market. So so for if your goal is 2 to 5 years, without second thought, you can choose arbitrage and conservative funds. Suppose, take another example. Suppose I want my kid to study in Spain and study in a football academy in Spain. Okay. So I just made my calculations. I found that I need 70 lakhs after 10 years. So what I do is like, based on some calculations, as my investment horizon is greater than 5 years, without second thought, I will just either choose large cap, and I will choose large cap and mid cap fund, and I will choose a perfect fund, and I will just invest it. So based on my investment goal and investment duration, I will choose all these funds. So based on your goals, you have to choose all these funds actually. That is the first thing. So if you go with these, you will not lose your money actually. So these are kind of secure, because for this very short term, all these are debt funds. So even though equity market can be volatile for 3 to 5 years, right? So it is 49,000. For the next 2 years, it may come to 30,000. So that's why if your goal is less than 5 years or less than 3 years, you should only go with the debt funds, because you are a type of a guy where you don't want to lose the money. But if your goal is more than 5 years, without second thought, you should invest in equity fund, because even though it may fall, suppose take the last year example. So in March, the market was like in January, the market was around 41,000. But in March, what happened? COVID happened. Then the market came to 27,000. Again, it kind of picked up now. So even though if another version of virus comes in the next 2 years, market may fell down, but it will again pick it up, right? Because the duration is kind of large here. So after 5 years, it will obviously pick it up. So if your investment horizon is greater than 5 years, without second thought, you should go for the equity fund. Now, so this is how you choose. Now, so you know where to invest the money, but you want to know like which mutual fund should I choose. So for that, let's take an, as I told you, like I mean, I skipped about ELSS, right? So ELSS is equity linked scheme. uh, it is kind of an equity fund actually, equity linked scheme where you can get the deduction up to like it will come as it will come under that 1,50,000 part. But ELS is like if you invest in that, it will have a lock-in period of 3 years actually. So we will just try to find a better ELSS fund. So I just want to invest in ELSS fund. So we'll just see how we can find a ELSS fund. So based on all the parameters, okay. So to find a fund which is suitable for you, we have to go to a website called Value Research Online. Okay. So Value Research Online. Now you have to go down here and there will be a call fund selector. Okay. So you can have all the funds. So in the left column, as we want to select a equity linked scheme. So I've selected ELSS and then I'm just updating the fund list. Now, so even though you are like going for this fund to for your tax savings, but your overall like I mean your long term goal should be like you should be getting the returns, right? So obviously returns are your main criteria, and also like you just want to invest in the famous funds because you don't want to take risks. So I will just filter out 2 1-star rating. I will just go with all this. So as we don't have much time, I have already prepared an Excel sheet actually. I will just explain you the Excel sheet so that it will be clear for you. Okay. So what I would do is like, so I want to select the only the what you say the famous funds. So I'm just doing the descending order of rating. So I'm selecting the top 5 funds here. Okay, top 5 funds. So I will only select from 5 to 4 star. That is my basic criteria. And here also, the next criteria would be next net assets. Net assets are the things. So that amount of money that the mutual fund is handling. So this Canara Robeco is handling 1538 and this Quant Tax Direct is only handling 49 crores. So I don't want to take risk even it is a 5-star rated. So I'm just removing it. So I have choose these Canara, Mirai, Axis Long Term and BOA AXA, DSP Tax Saver. So my first criteria is based on the ratings. So I have noted down all these 5. So all these for rating. Now so I just want to go with the funds which have more returns. So that is my second criteria, right? So for that, in this website, I'm going to the returns. Okay. As I told you, ELSS is a fund where we have a lock-in period of 3 years. So what I do is like, I will just go to, as I'm doing an SIP, I will just check the 3-year returns and I will just note down all the 5. So instead of noting all the 5, so I have already shortlisted my 5 funds, right? So I will just mark like if I so for the top 5, I am seeing like Canara and I am seeing Mirai Asset Tax Saver. So what I do is like I will go to the Excel sheet. If I see the fund in the top 5, I will just mark it as S. Why? And then my next criteria is expense ratio. Expense ratio is the percentage of the amount they charge you actually. So it is kind of for giving the salary to the fund managers or for giving the money to their expense. So this kind of expense ratio, as we don't want to lose more money, so obviously I have to choose a fund which has low expense ratio. So for this I have just shortlisted, I mean in the ascending order. Again I'm checking in the top 5, I'm checking like there is Mirai and as well also there is Axis long-term equity directly. I'm not able to seeing that Canara something. So what I do is like I go to the Excel sheet. I can just do it here. And I am seeing also Mirai asset. And then standard deviation. So what is standard deviation? So these are risk matters. Risk stats. So coming to the definition of standard deviation. So standard deviation is how much the fund can be deviated from its estimated returns. Suppose if ABSL tax 96 is estimated to give 1% return per year, it may give 1 plus 20.61 or it may give 1 minus 20.61. So it is a standard deviation. So obviously I have to pick up a fund which has low standard deviation. So for that I'm just descending. So 19.36. So for this I have to choose where my fund is coming here. So and also if you see all the funds that I have selected are not in the top 3. So the Canara is at 4 and my what Mirai is something it will be at 20, I mean some 15 to 20. But the thing you have to remember is the lowest standard deviation as part of this type of fund is 19.36. So I can take the risk of 21, right? Anyway, like if I lose, I will lose minus 80%. If I gain, I will gain 20 if I choose BNB Paribas. As Canara is have more returns and may like it is kind of high rated, I can go with this because there is no much difference of standard deviation when compared to the lowest one. So I what I did is like I just marked all everything as fine because these are all in the top. We have to check it like these should not be in the bottom. Like the highest is 26 and quant is kind of 23 as we have already eliminated because it has the low amount. So I have already eliminated it. So for standard deviation, it should be low. And then the Sharpe ratio. Sharpe ratio is it is kind of the ratio like actual return minus estimated return by standard deviation. So to simple terms, the more the Sharpe ratio, the good the fund is that much good. So the Sharpe ratio should be more. So if I do it as ascending order, I can see the Canara and Mirai and Access long-term equity. So I'm just marking it as Canara and Mirai. So I've already eliminated Axis long-term equity. I don't know why, but I did eliminate it. So Sharpe ratio, and then the beta. Beta is beta is the percentage that a fund moves when compared to its benchmark. Suppose if BNB Paribas benchmark is Nifty, if Nifty market goes up by 1%, this particular fund will go up by 0.83%. So if the Nifty goes down by 1%, this particular fund will go down by 0.83%. So you should select a fund such a way that the beta should not exceed more than 1. So all these are 0.95. So we just have to check whether the fund that we have recently selected has beta ratio should not be greater than 1. So my Canara and Mirai has less beta ratio. So I am going with that. Then alpha. Alpha is it is just expected actual return minus expected return. So the more the alpha, the fund is that much good. So the alpha should be more. So if I do the descending on alpha, I can see the Canara and Mirai. So I'm doing the alpha. So if I do all these parameters, I found that Canara and Mirai are kind of suitable ones. So because these have very good returns. So these is my primary elimination. So I eliminated these three. These two are the basics. So I can go either with Canara, Rebecca, and Mirai asset. So before investing in that, I just want to learn more about it, right? So what I do is like so I will just right click on these two funds and I try to get more information on it. So to get the information on a particular fund, it is better to uh, uh, what do you say? Better to you can either go to the Grow, which has a good UI, or you can just do the research in Value Research also. So let's do the comparison in Mirai and Canara. So if you come down here, so I'm doing the trailing returns. So you can see the graphs here, right? So this is a ELSS. So I have to check the returns of 3 years. So the blue line is our fund and this gray line is its benchmark. So each mutual fund will have a benchmark. So in all the cases, the fund that we are going to select should be kind of good when compared to the benchmark. So for this Canara Rebecca, like from the last 3 years, it never went down of its benchmark. So it is like always higher. So it is good actually. So let's see Mirai also. So for Mirai also, when compared to the benchmark and for the 3 years, it is also performing the same. For the initial years, they are same. But from the recent last years, it is also doing good. Then like there is no way to eliminate right now. So again, let's go by, let's see the top funds here. So for this particular Canara Rebecca, number of stocks are 54 and top percentage of top 10 stocks is 48. And if you see the top, these are the asset allocation. So this gray line is for all the equity linked schemes are investing on average 30.44% in financial sector, but this particular fund is investing 36.26. It is a bit higher, so they're kind of more inclined towards the financial sector, but it is okay because it is not like 80 to 90%. So that is why you should always ignore the sectorial funds because you don't want to bet on a particular sector. Your portfolio should be kind of diverse. So they are investing the sector average is 30 and your fund average is 36. It is good. And technology also it is more than when compared to the sector average, but it is good. And the top holdings are Infosys, IC, and HDFC. So these three are very good funds. So it is good. Like overall, this Canara is and Chinu Gupta is our fund manager, and this Canara Robeco seems to be good. And when compared to this Mirai asset also, like yeah, I mean even this graph is fine, and even these are also similar, like HDFC, Infosys, and ICI. So there is no way to like select a single one from these two. Okay. And also, when I said about mutual fund, I talked about the fund manager, right? Even though you are investing in a debt fund, even though it is a safe fund, at the end of the day, fund manager is the one who takes all the decisions. So before choosing Canara and Robeco, I just want to see who is the fund manager and how his experience. So to as a final step, I just want to see the fund manager history and experience. So to see the fund manager history and experience, so I can go to morningstar.in. So this is a website where I can check the details of the fund manager. So I'm opening the Morningstar website in two tabs so that we can select the, I mean, see the fund manager. So my first fund is Canara. Let me copy it. Yeah. So we are just like, I mean, into the last part of the video. Like, so I just have to pick up one thing. So based on mine is direct plan, hybrid fund, direct plan growth, right? Yeah. So I assume you know the basic definitions like direct plan, all those things. Like you can just Google it and study about that. And I find direct line growth. So these are the funds, and here you can also see the all the things. Like, I mean, so this Canara Robeco fund, this blue color line is its fund, and category is yellow, and index is red. So it is kind of very good actually. And Mirai also like should be good. It is very good actually when compared to the Canara. And this is what you can see here. And we were talking about the fund manager, right? So you can see the fund manager here. Uh, yeah, this is Canara Robeco. Yeah. So if you see the fund manager, the right now the fund manager is Chinu Gupta. Okay. If you want to know about the fund manager, you just have to click about the fund manager name. So it will open. And Chinu Gupta is a person who has only 3 years of industry experience, and his tenure performance is 22.23 returns. So, and when compared to index, like these are like percentage of returns they are getting. So he has 3 years of experience. So when compared to Canara, let's see about Mirai Asset Fund Manager. Mirai Asset Fund Manager is Nilesh Surana. Nilesh Surana, if you are very good with the market, you might have heard this name. So Nilesh Surana is a person who has 13 years of experience. Tenure experience is 21.24%, and years in start is 5%. So Nilesh Surana is kind of a person who has like more experienced. So the only thing I am like I can see here is like for in all the aspects, Canara and Mirai are fine. But when we compare the fund managers, Nilesh Surana has more experience because he has 13 years of experience, and he has seen the 208 crisis, and he is still in the field. So he seems to be a good person. So if you want to know, you can also check in about him in the Google. But he is a good person, he or she, I don't know. But he seems to be like a good person. So in based on this fund manager experience, and this person is handling this fund from the last 5 years. From the last 5 years, it is showing a good results actually when compared to the index as well as the category fund. So without second thought, when I compare with Canara, I will go with Mirai Asset Tax Fund because this kind of fund manager is kind of good, and this fund manager has been handling this portfolio. And you can also check the uh, let's check. You can also let me, yeah, you here, yeah. I forgot to show you one thing. You can also compare the index percentage. I don't know where did it go, but no worries. Like we already discussed. So based on all this, I'm going with Mira Asset. So right now, so I have selected Mira Asset. So even though it is a ELSS scheme, even though it has a locked in, so after 3 years, I should take a decision, right? Whether I should be invested here or I should be going to some other fund. So to know the performance of a fund, so this mutual fund companies are obligated to release the fact sheet. Fact sheet is kind of performance sheet actually. They have to release it for every month. So if you go to the Morningstar, if you click on the fact sheet, you can see the latest fact sheet of a particular mutual fund. So if you see the fact sheet, in the fact sheet, you will get all the information of the stocks that mutual fund is currently holding. So this particular fact sheet is kind of updated as on 20th February. Actually, it is rated. I mean, it is kind of recent. And the benchmark for this fund is Nifty 200. So, so benchmark for this particular mutual fund is Nifty 200. And if you see the here, so these are all the top holdings and the percentage of the holdings, and also the sector weights are everything. And the one thing you have to return is uh, the, this one here. So trailing returns. So let's see the 3-year trailing returns. So the fund is returning 16.66% of your money invested. The benchmark is returning 12.05, and the category, that ELSS category, is returning 8.70. So on average, the Mirai fund is returning 16.66% when compared to the benchmark, and when compared to the category, it is much higher. And you can also see the graph here actually. So this is the fund benchmark from 2016, and this is the benchmark, that green line, and this is the category. So it went down in 2020, but this is 2020, right? No, it is 2020. Yeah, somewhere like, even though it went down, but it never came down to the below the index. So even though the stock market was going down, it never underperformed when compared to the benchmark, and it is also going significantly high. So seems to be a good fund. But even though you're investing this, as it is a ELSS fund, it should be having a 3-year lock-in period. But after 3 years, you can stay invested in this, or you can just move to the other fund. So based on two things, you can just check the fact sheet and see how the fund is performing based on last 3 years, and you can also check the what you said, the about the fund manager. So if the fund manager is new, you don't know about the fund manager, right? And you are a guy who doesn't want to take much risk. So you, as at the end of the day, you are keeping your money in the hands of the fund manager. So the fund manager observation is kind of priority and mandatory one when you are investing in a mutual fund. So you have to see this. So manager timeline here, it is good, Nilesh Surana, but for this particular fund, the fund manager has kind of changed recently. So as I am a person who does not want to lose the money, I will just select this Mira asset and go with the ELSS fund. And how to invest? So once you shortlist the fund, you can just, as I told you, like, I mean, you can just either invest in Grow app, and you can find all the other things. So you can have a coin which is provided with Zereda, or you can directly go to the mutual fund site and invest it there. So this is how you can invest. This is how and you can invest in the mutual funds actually. And yeah, so the basic takeaway from this session is, like, I mean, you should be investing. So that should be the mandatory, at least 10% of your money. And based on your goals, you should be selecting, like, if your goals are less than 5 years, you should be going for a hybrid fund or a debt fund. If your goal is more than 5 years, without second thought, you should be going for equity fund. And you should consider all these parameters before choosing a mutual fund actually. So once you choose the mutual fund, once you invest in it, so like, if you want to take the money out of the mutual fund, it is kind of good to verify at least 1 year. Like, if your fund is underperforming more than 1 year, then it is okay to take the money out of that mutual fund. But it is not okay to take the mutual fund if the fund is kind of performing low for, like, not performing well for the 3 months. So 1 year is kind of minimum. So after 1 year, you can take the decision. And one more important thing I want to tell you is, like, before we close out the session, sorry, it's been 50 minutes. Okay, suppose, as I told you, like, I mean, I want my kid to be studied in Spain, right? So for that, I want 73 lakhs. So my long term goal was 10 years actually. Okay, suppose as my long term goal was 10 years. So from the ninth year, I have like 72 lakhs in my account, and I want my kid to travel to Spain in the 10th year. But unfortunately, at the start of 10th year, a COVID happened. So what will happen to that mutual fund? That 72 lakhs will come to around 65 lakhs. So I am just losing the money. So I cannot say to my kid that go and study in Spain after 2 years, right? Because I should be taking care of those things. So for these type of long term plans, you should have a buffer period. Suppose if your goal is 10 years, stay invested in equity fund 8 years. Then after 8 years, then you will know that the market is kind of bullish. Then take out the money and move everything into the debt fund for the last 2 years. As debt fund are kind of not volatile, even though you are getting a less return, your money will be safe there. So for suppose, like, if I get amount is 66 lakhs at the end of 8 year, I will move the 63 lakhs periodically to a debt fund. So suppose, like, in debt fund, instead of 75, I will get 72 lakhs only. But I can avoid this COVID thing, right? At the start of 10th year. So instead of getting 66 lakhs only after 10 years, I'm getting 72 lakhs because I kept the buffer period. So this is how you should avoid your losses when investing in the mutual funds actually. So this you should keep in mind. So keeping a buffer period when investing in equity fund. So in like after in the last 2 years, move that fund periodically to a debt fund. So these Coin and Grow will have an option actually. So we'll have an option to systematically transfer your fund from equity to debt. So they are giving that option. Select that option and do your thing. Yeah, so this is what I wanted to share it to you guys. I hope I was slow and I hope it is kind of informative. And I have recorded session. So if you have any doubts, go to the session or just reach out to me in WhatsApp. Okay. If you need this, actually, like as I told you, like I've created this PPT for just for my reference. So if you want, I can just add some relevant prepositions and give it to you so that when you want, well, like when you shortlist your goals, you can just choose a fund from here actually. So this is how you can. Praveen, your camera is on. Yeah. So this is how you can uh, like choose a fund and invest in a mutual fund and avoid the losses in the mutual fund. So this is what I learned from last few months. And I also read about the stock market, but it is kind of ocean. I'm still learning. So once I get the confidence on stock market, I do share with all of you if you want. Yeah. So if you have any doubts, you can ask me. Otherwise, we can wrap it up and see you in WhatsApp.
Sure. Thank you, Satya. Nice session.
Yeah. Okay. So okay then. That's it. So if you have any doubt, just please ping me in WhatsApp. Okay.
Yeah,
Sure.
sure, Satya. Thank you for giving information.
Yep. Yep. Thank you.
Thank
Yeah,
you.
thank you, sir.
Thanks, great.
Thanks.
Thank
Yeah.
you.
Bye bye. Yeah.
Bye bye.
Bye bye.